advising clients across the country. Here he is, your host, J. Christopher Boyd.
Welcome. This is Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner, and my office is Asset Management Resources. We're a registered investment advisor firm, and our show is a financial show where we like to talk about not only those important dollar and cents issues, but also the quality of life issues that make the money matters matter. And I am joined by Jeff Perry, JD, an investment advisor representative with Asset Management Resources. Thanks for being with us, Jeff.
Glad to be here. Good afternoon, everyone.
I am coming to you from the Asset Management Resources studio here in Hyannis, whereas Jeff is joining us from Port St. Lucie.
Yes, sir. Port St. Lucie, Florida, in case people didn't know. That's where it was. That's right. Treasure Coast of Florida.
It has been 16 years since our first show, Something More with Chris Boyd. This first weekend of May was the weekend we started 16 years ago. And so it's our anniversary. My mom, so sweet, sent me a beautiful orchid for the anniversary. She's keeping
That's
track.
Wonderful. I love that.
Yeah.
Isn't that
nice? Yeah.
We still want moms to be proud of us, no matter how old.
Yeah, exactly. I used to, every show when we used to do the show more often. We do it live on occasion, but we used to do it live every weekend. And I'd call my mom on the way home from my shows for most of those years.
As you should.
Be like, so what'd you think? When we started out anyway. So the first show we did, we had not had the opportunity to have our commercials recorded in advance. So we were reading script, the commercials of companies like Capital Payroll. And
they've been a advertiser since the beginning.
Since day one. Since day one. So not only do they have such great services, because we're big fans of Capital Payroll for if you're dealing with your own payroll, don't waste your time.
Which I don't know why any small business would attempt to. There's so much regulation, and
you can avoid all the headaches of there's a lot of potential for fines and things if you don't do it properly. So, and you have experts that you can draw on. It's just they do a great job, and we've been thrilled for a long time with them. But and it's so nice that they've been a partner and a sponsor on our show for the last 16 years. So in any case, along with Boyd and Boyd, and of course, we've run our own ads throughout that time, but we've had other sponsors come and go. But anyway, thank you for our listeners for being with us for the last 16 years. Hard to believe how time has flown.
That's for sure.
Now, Jeff, I got to ask you.
Yes, sir.
Are you hungover? Cinco de Mayo last night. A little bit of cerveza. What do you think?
No, I'm just fine. Thank you.
Okay. You survived. One of the things I was thinking about is we want to maybe try to do our format a little differently. You may notice that over the next few weeks, we're going to tinker with our programming a little bit, and maybe we'll do a little longer segments here and there. So let us know what you think. We'd love to hear back from you. Love your feedback. We always love hearing from our listeners. If you should want to, there's many ways you can communicate with us and connect with us. As you know, we put our show out as a podcast each week on wherever you listen to podcast, iTunes, iHeart, Spotify, Audible, wherever you listen to podcasts, we put it out. So you can connect with us by keeping track of us that way. We put all our stuff out on social media as well, pretty much, the big social media locations.
Everything but TikTok. No TikTok.
No TikTok. No, we don't do that. And
not yet.
No, we're not doing TikTok. I don't dance that well.
Okay, boss.
So in any case, we also have the ability to reach out to us by email. So you can email radio@amrfinancial.com, or you can send us a text if you like, 508-915 3,700. So anyway, we love hearing back from you. If you have, whether it's through social media or reach out directly, let us know what you think about things we're doing on the show. If you have questions, you have ideas, topics, you have things you want us to make sure we're addressing, we can certainly do that. So in any case, let's jump in. Give you a little bit of preview what we've got planned for today. We're going to be talking a little bit about what's going on in the news in this hour. Next hour, we'll be talking with Brian Regan as well. And later this hour, we're going to be joined by Nicole Spencer of Heroes in Transition. So lots to go over, more to cover than time allows. So
as always, right?
Yeah, I think that's the case. And if I have time, and I have a feeling we're not going to have a lot of time for this, but one of the things I've been doing over the last few months, this year, I've invested in my own education, and there's always things to learn. Even though when even as a professional being in the business, I've been in some form or fashion connected with financial services for probably 30 years or so. I started as a life insurance agent in 1990. And started what has become this business in 1996, though we formed the Registered Investment Advisor firm in 2008. But so it's been a long evolution, but there's always things to learn. And so I've been investing in taking the Ed Slott program, the Elite.
You went to a big conference a month or two ago.
Yeah, well, no, yes, I did in February. I went, and then you were on for me last week. I was at this another one of their programs, the Ed Slott's Elite IRA Advisor Group, and that was in the DC area when I went to that. So, right. So I thought if there was time, we could just talk about some of the just little tidbits. There's so many things we could touch on, and some of them get pretty like nitty gritty complex, but I thought we might be able to just spend some time on some of the just good basic reminders of things that we could touch on. So we'll see if we have time for that. But before we do that stuff, let's talk a little bit about what happened this week a little bit. Jeff, I was thinking the Fed had an announcement this week of a 1/4 point rate hike, but it is widely expected that this will probably be the last.
Please, yes.
Obviously, data dependent, but it is expected that we probably won't see more of these rate hikes for a while. I understand that if inflation continues, it will be something that we'll revisit. But please. Let it be the peak of the rate hikes for the time being. So we've gone from 0 to about 5 to 5.25.
Yeah, that's the Fed funds target rate right now, 5 to 5.25 exactly. Yeah, another 1/4 point hike on Thursday.
Isn't that incredible? When you think about the speed and severity at which we had these rate increases, it's astounding.
It is, and if for no other reason than to give these rate hikes time to filter through the economy, which let's kind of go back. The Fed is trying to slow the economy because they want to slow the rate of inflation. So they're raising rates to have businesses and individuals do less economic activity, to borrow money, right? That's the basic premise of it all. But they have to give it time. They have to let the economic cycle progress and let businesses naturally slow. And I don't know if you want to talk about this, but what's been on my mind, especially after Thursday with another rate hike, is how much pressure is this putting on not just the traditional things that we think about, but on these regional banks who have.
Yeah, I definitely want to talk about that.
Right.
Before we jump into that, let me just mention to our listeners, if you follow us on social media at all, whether it's Twitter or Facebook or wherever, if you follow the Asset Management Resources social media, you'll have seen Brian Regan, our firm's chief investment officer, talk a little bit about the FOMC, the Federal Open Market Committee meeting, where this rate hike occurred. and put it into some perspective. This is something we try to provide our followers a little bit of insight in the moment, so make sure you're following us for these kinds of details and as they're happening.
Usually the same day, Brian jumps on and records something.
Exactly. So, could be a useful resource for you. So, as you said, the goal is to slow the economy. Why? Well, because we got inflation that's been pretty high, and we do see signs of inflation slowing, though not to the point where it's desired to be. But there's some aspects, we've talked about this in the past, as we look at the way the calculations work, that it's almost inevitable that we'll see some additional slowing of inflation. So good that the Fed has slowed this, or looks to be slowing this. I understand that there's increases in other parts of the world as well, with their dealing with inflation in Europe and so forth. But this has a dramatic impact on the consequence. It does have a slowing effect in the economy, but we've also been seeing this issue of banks having some problems, and we've seen some bank failures over the last month or so. It started with the Silicon Valley Bank. Was it Signature Bank was the other bank?
Correct.
And then
Republic.
Let's talk about First Republic Bank.
Right.
You want to chime in a little bit about what happened this week as it relates to that?
Well, First Republic is a regional bank, and I think when we say regional bank, or at least I do, before this latest situation, I think of
What's that?
a smaller bank, right? A bank that is in a region, but First Republic and some of the other banks that they're talking about, including at the end of the week here, PacWest, Pacific West, another regional bank, obviously located on the West Coast. These are really big banks. These are banks that are in the top 20 banks of the nation. So, what do you do if you're a account holder, or you have your business assets, to it your payroll or some of your bigger accounts, in a regional bank, and there was reasons to be in a regional bank if you're a business owner? Certainly those relationships, lines of credits. But what do you do in the middle of this crisis? Well, a lot of companies or individuals say, well, I'm going to withdraw my money from that bank, which just adds kind of fuel to the fire.
It's a run on the bank ultimately, isn't it?
Yeah, maybe not like in the movies where everybody's outside, but
yeah, Mama Dollar and Papa Dollar better start making babies, right? With the It's a Wonderful Life.
Exactly. That was the image that was in my head as well. But, so I did see some commentary on, I think it was on Bloomberg, where it's even magnified now, because it's not like you actually have to go to the bank to withdraw money and talk to somebody and go through this process. Now you click buttons and you can be moving business owners or individual depositors. So the more people get worried about a bank that might be in the news, like First Republic, the more pressure it is for people to think, well, maybe I should move my money to a big bank where it's allegedly safer. And it just is like a contagion thing.
Yeah,
and so
it is. It's funny. I think about businesses. When it comes to individuals, you can say how it's very manageable to say, let's keep, 250 to 500,000, if it's a joint account or whatever, let's keep within the FDIC insurance limits.
Right.
When you're dealing with big businesses,
especially payroll accounts or
payroll, right? You can see how do you functionally accomplish that? That
right.
can be very challenging. So it is interesting to think about how they're going to address this challenge, because as a business account, you might see the challenge of keeping within those parameters and be much more susceptible to the risks and the need to react and be, sensitive to moving funds between banks.
Absolutely. So I guess about a week ago, last weekend, the Federal Reserve and the FDIC were looking for a buyer of First Republic.
Yeah.
And they had a little auction, I guess, private auction. I don't know how all that happened.
Essentially, right.
They're basically saying, put your best offer on the table. And And the winner was JP Morgan, Jamie Dimon, and 10 odd billion dollars or whatever the number was. And so everybody thought maybe, go ahead.
So I was just saying, yeah, I don't know how JP Morgan, Jamie Dimon, keeps doing it, but in moments of difficulty and challenge, it's interesting to me that JP Morgan keeps coming up as one of the big banks, and this has historically been true for JP Morgan in times of crisis, that this organization has been able to step up. Now, I'm sure there's a financial interest in it. It's not just
he's
item of good, like just being a good citizen.
Well, think about your neighbor who might be in trouble with their mortgage and their house is worth 500 and they say, do you want it for 200? I got to get out of it. You're going to find,
you might find the money, right? If you have resources.
Yeah, right.
At the same time, though, where they're losing clientele, fast. What is the value of an asset like that, or the deposits moving? Maybe it's the kind of thing where you secure that, it eases that challenge and it becomes more clear. But anyway, I'll give them a little bit of kudos, and even though I'm sure there's some financial benefit coming out of it,
I have no doubt that it's in the best interest of JP Morgan. And I don't know if other people see the hypocrisy, and I'm not saying it's the wrong decision, but I'm just kind of political comment here, where this administration and the federal FTC and such are really against mergers and acquisitions. A lot of pressures on companies who are trying to merge or companies who are trying to buy anybody. But, we have a situation here where the feds are basically asking one of the biggest financial institutions, which they're worried about getting too big, to step in and take care of the situation. It's just, it's fine when it's convenient, but
well, I'll tell you what, there was an interesting tweet from Liz Ann Saunders following this. I'll just share this with you. She said this was from Statista, I guess. But anyway, she had an image, but also some stats here where the number of U.S. banks in the 1980s, early 80s at its peak, there were 14,469 U.S. banks, commercial banks.
Yep.
By the end of last year, it was down to 4,135. So, 10,000 banks that are no longer segmented into institutions. They've been merged and gobbled up. So this issue of too big to fail, is remains a concern, right? But at times when there's challenges, these too big to fail institutions are able to step in and buy more because
at a bargain price.
And it prevents, ultimately there's some social good in this, and that it prevents this bank from failing. And ultimately, it essentially did fail, but prevents the underlying. This isn't a cost to the FDIC or to the consumer.
That's right. Well, if you're a shareholder of First Republic or Signature or Silicon Valley, it failed to you.
That's right.
Your investment was wiped out, but not from the sense of a depositor. And this brings up the other issue, if you want to chat about it, is, do we really have a $250,000 FDIC limit now per person?
That really does raise a question how they're going to deal with that. I think there is. I think that is the case. And if I were in an institution where I had more than 500 or $500,000, 250 or $500,000, like over the FDIC insured amount, I'd still be nervous, even though right now there's, some implied backing, but how long will that really last? And when, will they say, well, that was only for this instance?
That's right.
I'd still be a little bit unsettled by that, where I'd want to be in a position where I have less clear, or I have more clear coverage. What's my situation? You know what I mean?
I don't know if you remember, Chris, but when we were filming the Something More mentoring video on banking, which was probably, I don't know, might have been a year ago when we did this. And for people who don't know what we're talking about, they can go to our website, amrfinancial.com, go into Services tab and scroll down to something more mentoring. And near the bottom of the page, you see all these educational videos on various subjects. And one of them is on banking. It's on assets, liabilities, and banking. And we were talking about this FDIC and, saying it's probably prudent if you have more than $250,000 or $500,000 to use a second or third or however many you need financial institution. And I have to say, when we were recording it, it is the right comments to make, but you didn't really think like, yeah, that's not going to happen, right?
Not something you're really worried about.
Right.
Yeah.
But it's still the right advice, and it still holds up, a year later. But you don't really think about it. And even if you're a depositor in one of these banks, if I was a depositor in right now PacWest, which is kind of going through the First Republic initial stages, and I had $249,000 in the bank, I still might think about taking it out because I don't want to get caught up in a.
You don't have to deal with that, right?
How long does it? If we have a failure, and I need that money, how long does it take the FDIC to process all this?
That's a really good point, Jeff. I mean, who wants to have to endure dealing with those kind of challenges? So yeah, even though you might have protection, it still is something you still would prefer to avoid, right?
Having said all of that, I love regional banks. We bank with Seacoast Financial here in Florida, a regional bank. I'd rather, if I had my choice and everything was perfect in the world all the time, which I guess it isn't, but I prefer dealing with a smaller institution where I can go into the headquarters. I can talk to if it's not the CEO, I can talk to a vice president who can make a decision. And, I don't have to stand on the 800 line or, in some long line at some money center bank. So it's tough for consumers to know what the right thing to do is.
We're talking about some of the news of the week. Jeff, I thought maybe in addition to some of these, topics with regard to the banks, and I think this is not an issue that is resolved entirely, as you pointed out, with, there remains other banks that they're still watching, but it's not the financial crisis. It's not the same kind of vast exposure to these kind of problems. It's more selective. Not that makes it easier for anyone who's involved in these challenges, but generally consumers probably don't have it's not all banks that you have to be worried about right now.
Absolutely.
Right. But I tell you, one of the things that I have been hearing more from clients and just questions about has been what's the happening with the debt ceiling and what to expect. Maybe we can take a few minutes and talk a little bit about that. What do you think?
Well, I'd love to. We've talked about it on the show at least once, maybe twice before. Not recently though. So, and we have the debt ceiling deadline, if you will. As Secretary Yellen, Treasury Secretary, has said, was it June 1st? Is kind of.
Yeah, she said as maybe as soon as June 1st, we might be at a point where we could risk default. There's a lot of moving factors that can affect this. But, essentially, they don't have the debt ceiling issue resolved. And there's been some, we'll talk about what the movement has been, but this was one of the developments in the last week or so was this June 1st kind of, as soon as June 1st could be a problem, though it's not absolute. And we've also had, the House bill that got passed, that was more than a week ago now, right?
It was. And I think it was around the 19th or 20th of April. So a couple weeks ago.
Yeah. Well, just on this point, I do want to make a quick mention. We're going to have a great guest. One of the early guests of the show 16 years ago, we had David Walker, former Comptroller General of the United States, on as a guest, and he has been focused on the issue of the debt of our nation for years, and pointing to just that this is ultimately problematic. We've been in a period of time where it hasn't been as problematic because of the low cost of debt, but that's changed and changing.
Yep.
And so I invited him on. He's going to be on May 20th. So we'll have him on in a couple of weeks. So we'll have more to talk about this. Hopefully it's well timed with all that's going on. I have heard people suggest that there's a possibility. I think it was Michael Townsend that said that there's a real good chance that they'll just kick this can out to September and do some kind of a temporary patch to buy them time in DC. To
I can see that. I can see that happening, which is also, October 1st is the beginning of the federal budget.
Yeah.
So
tie it to the budget process and all that, maybe, huh?
Yeah. President Biden, who drew a line in the sand, I guess. I don't know if he'd call it that, but an apparent line in the sand where he said, I'm not going to talk about the debt ceiling. Just pass it. We'll talk about other things later. Had that pretty firm stance until, as you mentioned,
I gotta say, this is an issue on which I agree. I know we've talked about this and that there's leverage and there's politics and there's all the realities of this, but the full faith and credit of the United States government should not be at risk. And if you want to talk about budget issues, how much we need for revenue, what we need to cut for costs, that's a budget issue. And that's a great thing that we should spend time on and debate and figure out, how to reduce the amount of debt that we're accumulating. Because it's perpetual, it's serial. It doesn't matter which party's in charge, it's constant that we raise debt.
True.
So I'm all for a conversation about how do we slow that and, ultimately reverse that process, but not at the risk of a default of the credit of the United States. Anyway, that's my 2 cents.
Which hasn't
that being
changed.
Said, that, there's a political dynamic to it. What's that?
I said, which hasn't changed.
It has not changed. I've said it before and I'll say it again. I'm just trying to convince a few other people that might be listening to say this isn't something we should be playing with. It's not a game of chicken.
So I guess it depends on your definition of playing with or chicken, right? So I think in principle, just strictly principle, I agree with you, right? I love taking single subjects. I think our founders were direct on when they wrote about the single subject rule that should be in Congress. You take one thing at a time, you deal with it, you vote it, so forth. No promises on other matters, but that's not the political life we live in. In fact, 8 of the last 11 debt ceiling situations have resulted in negotiations and compromises on things that were not just the debt ceiling. So this isn't something new. And
no, it's certainly not. Yeah.
Sure. The Republicans and Speaker McCarthy were in a tough situation because President Biden, I think strategically correct, said, well, my plan is to increase the debt ceiling. What's your plan? And the Republicans had some trouble kind of putting out a plan. But as you mentioned a couple of weeks ago, they put out a plan. Certainly not a plan that the president or the Democrats like.
Yeah, let's just talk about that. So first off, a thin majority. So the speaker was able to cobble together the not unanimous, but almost unanimous
he lost 4.
backing.
Yeah. He lost 4 Republicans.
The Republicans, but the bill that was passed, it's just impossible to think that Democrats in the Senate would be willing to consent to. Maybe you can tell Jeff what are some of the kinds of things that this was looking to repeal funding for.
Oh, sure thing. So they're looking to pair in the bill $4.5 trillion of spending cuts, and I'll outline them, with the $1 trillion increase in the federal debt limit. So they wanted to get rid of some of the spending over that has already been, to your point, which has already been appropriated. And they wanted, the first thing.
But I think there are things in there that you could say, oh, well, there's things that we're not using the way we planned for COVID, or there are things in there that they can make a really good case for, I think.
Right. So let's start with one that I think they'd probably agree with. Clawing back $5.2 trillion of COVID-19 unspent money, right? That's, that was earmarked money, and it's still sitting there. I think most people of good faith would say, we can take that money back, right?
I would leave some of it for testing still to be available. We make
Fair
test
enough.
costs available, but I mean the expenses that were expected, clearly not going forward.
All right. Now the next couple are going to be.
We just got 2
things-
minutes, by the way.
So I'll go through them real quick and you can comment. Cancel the student debt relief program that the president put out there.
Mhm.
That's, IRS budget, get rid of that $80 billion in expansion of IRS Army. Repeal some green tax incentives, tighten work requirements for some federal programs, and increase authority over regulators, and giving some incentives. So it's not just cutting, but giving some financial incentives to the oil and gas industry. So,
and I think some of those things are like very much tied to what the Biden administration would point to as their, legislative agenda that they've accomplished. It undercuts the funding of some of the things they've just tried to accomplish, which, clearly that's understandable why Republicans would want to do that. But my point is, it's not it's kind of a non-starter for the Democrats as to whether or not they're willing to agree to it. So we've still got a problem.
we have a problem, and the president has agreed to a meeting with Speaker McCarthy this coming week. And my guess is it's going to be a hybrid of, we're going to raise the debt ceiling either short or longer term, and we're going to make these commitments, meaning the administration will make some commitments when it comes time to the budget cycle itself for the next fiscal year, where we'll do the COVID thing and maybe we'll make some cutbacks and some other things. And
yeah,
compromise.
There's room for compromise to be found, though.
There is, and I think
we can get enough people on both sides of the aisle to agree to vote for some of these things is what's the unknown.
Well, that's the thing here. It's not going to, people say, well, the Republican House will never pass what President Biden wants, or a debt ceiling relief without some of these things. Well, it doesn't have to be just the Republican House. They need a majority.
Right.
It can be a Republican, it can be, we'll see, Republicans and Democrats working together to get to majority in both chambers.
Well, we'll probably be talking about this more because, the idea of if there's not a passage of some solution, it's a little bit, worrisome to think about. But it's not what was our base case expectation. And we think generally declines that are likely to come from anxiety of this might be an opportunity to rebalance and use it as a buying opportunity. We're at the point where we need to take a break, Jeff. Thanks for, the good insights on some of this stuff we've been talking about with the news this week. If you need help with any of your financial planning or portfolio management, reach out to us at Asset Management Resources at 508-771-8900, or you can reach us through our website, amrfinancial.com.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.